A typical buy rate for a loan is usually somewhere between 5 to as much as 15 percentage points or more below what it actually costs you. But this time, it's the second merchant cash advance lender. They'll pay off the first one. They didn't tell you that it's their sister company and they're just double charging you. We provided that they've got merchant cash advance loans that are unfortunately all over their bank statements and hindering their cash flow and putting them in a very difficult situation to survive. Why do you think they would care about your customers or sending a letter to your customers? Or why do you think they would even care about you? So try those little different banks that have the kind of weird name you never heard of before. You'd be surprised at what kind of lending options they have. Welcome to the next episode of the Mobilization Mindset. My name is Scott Peper. I am the CEO and founder of Mobilization Funding, and today we're going to be talking about a topic I'm very passionate about. It's merchant cash advances, otherwise known as MCAs, and why they are so bad for construction subcontractors, construction companies, and manufacturing companies overall. What is an MCA? Well, it's a merchant cash advance is what the acronym stands for. But an MCA, they may call a loan, they may call it a purchase of receivables, but at the end of the day, what it is it's access to cash very quickly for a company who usually is in a very dire need. What a merchant cash advance is it's an advance on your future receivables as determined by the deposits that are put into your previous 4, 5, or 6 months checking account statements. So what they will look at your checking accounts, see how much of your deposits have gone into that account, determine that that is a reasonable amount of revenue that they could forecast moving forward, and then they're purchasing a percent of those future deposits or otherwise receivables. Very similar to the way that a factoring company might try to buy your receivables, except they're not buying the specific receivable or taking title to that specific receivable like a proper and good factoring company would. They are just using terminology that is similar to factoring to position a advance of money to you as a company in a way that they can charge extraordinary amounts that are not a loan. Factor rates. I use that term. What is a factor rate? Well, it's not an interest rate. You're not paying an annual percentage rate. It is a factor rate. And what that means is they are creating a percentage rate they're going to charge you for the amount that they've provided to you in the advance amount. Let me explain. $100,000 that is going to be advanced to you in terms of an MCA means you're going to receive $100,000 in cash. The factor rate is what it's going to cost you. It doesn't matter. It's not an annualized percentage rate. It's a factor rate. So that factor rate usually can float anywhere between 18 and as much as even 75. What does that mean? It means on $100,000, you're going to pay back $18,000 to $75,000. Now, here's what you need to understand. The majority of these MCAs are sold, marketed, and pushed upon you by a broker network, not the direct lender. Even when most of the brokers are telling you they're the lender, all they're doing is white labeling a company above them that is really providing the financing. Now, why is that important? Well, brokers work on commission, and there's nothing wrong with earning a commission. Everybody should. However, the merchant cash advance lenders have created an environment that allows these brokers to go way overboard, charging companies more excessively than they ever should. Not all, but some. A typical buy rate for a loan is usually somewhere between 5 to as much as 15 percentage points or more below what it actually costs you. So what does that mean? Using my example of $100,000, that broker might hear from the MCA lender that the buy rate is 25, meaning they will give you the $100,000 and you will pay back the lender $125,000. However, they've given the broker the ability to mark that buy rate up as much as 5, 10, or 15 points. So the same 1.25 factor rate to you all of a sudden becomes 1.35. That extra 10 percentage points, or in this example, $10,000, goes to the broker. They're obviously heavily incentivized because you can earn an extraordinary amount of money as a commission from a lender by selling the manufacturing or construction company this loan or this MCA. So I said I'm passionate about this. Well, as the owner of a lending company, why would I even care about another particular loan product that's not even a loan? I don't compete with them. What I care about, why I'm passionate about it, is I know what the wrong loan solution or the wrong capital solution or the wrong cash solution, whatever word you want to use, I know what that can do to a business owner who doesn't understand exactly cash and how it works in their business, and cash flow and debt service and accumulation of debt, and what it can do to their extended months and life cycles of their business when they're just working their ass off and trying to do what they do and deliver for that service or product to their customers. So why I care about it is because I know that if you are a merchant cash advance lender and you're providing a loan to a company for working capital that doesn't get paid for 30 days or 45 days from their customer, or it's going to take them 4, 5, 6, 7 weeks or longer to execute the work, but you start taking payments daily or weekly, and you don't even care about what margins this company is operating out of, and yet you're going to charge them 2, 3, 400% more than their margins are, you can't possibly care about them. And when you've actually been around long enough, and MCAs have been around since at least 2015, at least 2016, you've obviously seen what they've done to construction companies and manufacturing companies before, and you know it's not good for them. So the only reason you would ever call on a construction company or a manufacturing company and deliver them an MCA at a buy rate or factor rate over their margin that they even make is because you don't care. But as a consumer and as a business owner, you must know what is happening, and that's the purpose why I'm passionate about it. And the truth is, we're more often than not, we are a great solution at mobilization funding for a lot of these companies, but we can't provide them a loan because they have merchant cash advance loans that are unfortunately all over their bank statements and hindering their cash flow and putting them in a very difficult situation to survive. Those are the situations I'm passionate about and I want to protect people from so they can look at it in advance. Let me walk you through a very common story. We'll use the same $100,000 example, and let's just take any construction contractor. We had a contractor who was in the specialty trades, borrowed $100,000 from an MCA. Why? Well, they were short payroll one week, and you know what? It wasn't even their fault. They were expecting a customer to pay them last week, didn't pay them. This week, didn't pay them. Well, now payroll's due. So they got one of those phone calls from the broker. They searched for a loan and got a phone call or got something in their email, and all of a sudden their $100,000 problem could become a solution within the next day, and they took it. $100,000 comes in, they signed it up. It was a factor rate of 40, meaning they were going to pay back now $140,000 over the next 10 months, divided by the amount of weeks that are in those 10 months, and that was their weekly payment. That payment started the very next week. Here's the problem. They started not to get paid by that customer, and then when they did get paid by that customer, $10,000, $20,000 had already been taken out of their account. The other problem is this particular construction subcontractor operates off of about 15 to 20% gross margins. That means for them to make $100,000, they need to produce $500,000 in revenue to make 20%, which is $100,000. Now, they have to execute $500,000 worth of work, and they have to be paid $500,000 worth of work, and they also have to use none of that money for anything else other than creating $100,000 of income so they can pay back the $100,000 loan they received. But wait, we're not factoring in the additional $40,000. Okay, that means they now have to produce another $200,000 in revenue to pay back the $40,000 of cost. So the next $700,000 in revenue over a 10-month period of time has to take the profit from that just to pay back this $100,000 emergency and the $40,000 that it's going to cost them to pay it back. And when you don't understand that that's the case, And when you realize that this company is only a $2.5 million business taking out $100,000, you say, what's the big deal? Well, the big deal is now 33% of your revenue has to go to pay back this loan. That's where the problem is. Now, using that same example, let's say everything goes smooth and you pay it back and you figured it out. Great. But what happens if you miss a payment? What happens if you miss 2 payments? Have you ever tried to call the MCA lender? I know some of you are probably chuckling right now. It's hard to get a hold of them. You can get a hold of that broker again. And what's the broker's solution? Yeah, they might be able to stall a payment for a week. They might be able to even stall a payment for 2 weeks. And sure, that's helpful, no doubt. But what's their NX solution? To offer you another merchant cash advance loan. But this time, it's the second merchant cash advance lender. They'll pay off the first one. They didn't tell you that it's their sister company and they're just double charging you. But even if it's not and it's a brand new company, a new lender, you now are just forced to pay back the same amount over again just because you're solving a cash flow issue. And that same math I gave you with the $700,000 in revenue now is becoming 1.2 or 1.3 million in revenue. The issue there is you're kicking the can down the road that by the time the problem surfaces again, it's an enormous problem that's 10 times larger than the original $100,000 problem you had. So you're like, okay, Scott, Captain Obvious, what do I do though? Well, there's a lot of things you can do, starting with working in advance and protecting yourself by proactively finding lending solutions that you know will work for you if you're going to try to grow your business. Or if you're in the construction or manufacturing trades, you know things are going to get tight. They're going to happen. If you focus ahead of time on finding the right solution and work with those companies, you can be ready and on deck with them. That's my first suggestion. If you still find yourself in the middle of that week stuck and you're about to miss payroll, I would strongly urge you to think about having that tough conversation with your team and your employees to buy that extra week to find the right solution. Then you would be quick to quickly take that payment, and there's lots of resources out there. Now, let's say you miss a few payments. Let's say you're with the wrong MCA lender and they start to get aggressive. What do? By the time you've read the actual agreement you signed, you quickly realize that you've lost a lot of control and a lot of flexibility. And they do have the right to now start sending letters to your customers stating that those receivables they purchased are owed to them. That obviously creates an enormous amount of problem and difficulties within your business and certainly managing your customers. Those are some of the most aggressive tactics that are used. Why are those aggressive tactics used in the first place? Well, think about it. If you don't care about margins up front, if you don't care to know enough information that you can put $100,000 in a business's account within 24 hours, if you don't care enough to charge 25 basis points factor rate and add 10 extra points to it or more, why do you think they would care about your customers or sending a letter to your customer? Or why do you think they would even care about you? The truth is they don't. And you know what? That's okay too, as long as you know that in advance. But when you don't know that in advance and it becomes a surprise to you and you try to operate and work with them just like you would any other regular lender or capital provider, like a bank or a factoring company or other good, adequate private lenders, you quickly realize that you're in a bad spot and you're like foot's in the trap and you're trying to figure out how to get it out. I know I've gone through all these and I've told you lots of bad stuff, but here's the truth. There's lots of great solutions out there. And if you're watching this video, I hope you're watching it before you ever get yourself into this scenario. And this is the part of the video where you're going to like it a lot. If you have been in this situation before, you're probably kicking yourself saying, I wish I knew these solutions. And maybe you've done great wonders to get yourself out of these merchant cash advances and you never want to go through them again, but you still want to grow your business. This is the point where you want to grab your pen, pay attention. I'm going to walk through some great options and solutions. The first, traditional lending. Now, a lot of people think you're not capable or the bank isn't available to you, but there's a lot of programs within a bank. And for those of you that are working with big banks like your Wells Fargo's, your Bank of America's, your Chase's, you know what? If you're a local community construction contractor or manufacturing company, those banks probably don't have the great options for you. And that doesn't mean for our friends at those big banks that I have any ill will to you. I have none. I actually think you're amazing. The reality is there's a reason why community banks exist. And inside those community banks, they typically have community lending programs that have a lot less stringent standards. For example, there's a local community bank here in Florida and New Jersey called Valley Bank that has a lending arm. And they will give lines of credit to businesses up to $100,000 that are based off of very limited criteria that they otherwise would not be able to get approved through their commercial lending division. And Valley Bank is no different than any of the other community banks that are out there in all the different states and where you're at. So try those little different banks that have the kind of weird name you never heard of before. You'd be surprised at what kind of lending options they have. Now, the next would be your SBA loans. That's the next tier up from your community lending programs, meaning the bank can't give you a loan yet because you can't get approved through their standards, but they can get it approved through the SBA standards, which is also a great option for you. The next would be the regular community bank loan or regular standard loans or line of credit. Then you have private credit options like invoice factoring or purchase order financing. Now, there's lots of different factoring companies. There's lots of different purchase order companies. You have to find the right one that understands manufacturing and understands construction. And there are a few. Good news for you, all of these things are listed on our website at mobilizationfunding.com, and you can find great info on all of these options and sources right there on our website. And then last but not least, there are such things as working capital loans, WIP financing, and purchase order financing that you can use for progress type billing. The things that construction subcontractors and manufacturing companies need. True purchase order financing where, you're not delivering just a finished good from your supplier to your end user. You actually need to order 3 or 4 pieces of raw material. You have to bring them into your manufacturing facility, create that finished good, package it, ship it, and deliver it. And is anyone at a regular bank or other place understand that that's something very simple for you to do, and you have these great orders from these great customers of yours, but no one wants to take the risk on your ability to perform? Well, there are companies out there like that. Mobilization Funding happens to be one of them. And if we are a good option for you, again, the information is listed on our website at mobilizationfunding.com. Same for the construction subcontractors. Progress billing, milestone billing, work in progress, it's really hard for a lot of people to understand in the lending community, and for good reason. It's not easy. What you guys all do is very difficult. So there are good options out there, and you can find what those options are for you as well on our website. I hope this video has proven fruitful and helpful for you. I hope you can share it with your friends, your family, your fellow business owners, anyone else that you think out there could listen and use and require some of this information for the benefit of them and their businesses. In the meantime, I hope you all have a great week, and may God bless you.